While the world's attention is fixated on the price of oil and the blockade in the Middle East, a potentially far more dangerous crisis is ticking down in the background. This seemingly isolated geopolitical conflict has severed a critical supply chain that mathematically guarantees a catastrophic wave of global food inflation by early 2027. Now, JP Morgan analysts recently calculated that if the Strait of Hormuz blockade holds, the combined storage capacity of 7 major Gulf oil producers will be completely saturated within just 25 days. However, while oil-producing nations have pipelines and strategic reserves to manage these disruptions, the world has built absolutely zero equivalent infrastructure for fertilizer. So today, we're looking at the plumbing of the global agricultural system and showing you why the current energy crisis is actually a delayed food shortage. Now, initially, it might sound like a bit of a stretch to connect a missile strike on an energy facility to the price of bread in your local grocery store. But modern agriculture is fundamentally an energy conversion system where natural gas becomes ammonia, ammonia becomes nitrogen fertilizer, and that fertilizer ultimately becomes human calories. Natural gas serves a dual and completely irreplaceable role in this complex manufacturing process. It acts as both the physical hydrogen feedstock for synthesizing ammonia and the raw energy fuel required to sustain the extreme temperatures of the Haber-Bosch chemical reaction. Without abundant and cheap natural gas, the global fertilizer production chain physically cannot function at the scale required to feed the planet. To put the sheer scale of this dependency into perspective, roughly 50% of global food production relies entirely on synthetic nitrogen fertilizers. That means approximately 4 billion people are currently kept alive by an agricultural system that is entirely dependent on fossil fuels. And the Middle East absolutely dominates this specific industry because their incredibly cheap and abundant natural gas creates massive structural cost advantages over the rest of the world. And under normal conditions, this highly optimized system works incredibly well to keep global food prices low and supermarket shelves fully stocked. But the critical vulnerability of this globalized system is that it relies on a handful of incredibly narrow maritime chokepoints to distribute these vital chemicals. And that brings us to the geopolitical contagion that is currently paralyzing the industry. In mid-March, a series of Iranian missile strikes caused extensive damage to Qatar's Ras Laffan industrial city, which serves as the world's largest liquefied natural gas export hub. Qatar LNG immediately confirmed a 17% loss of their export capacity and was forced to declare force majeure on multiple long-term international contracts. And because natural gas is the foundational ingredient for nitrogen fertilizer, Qatar LNG was also forced to completely halt the production of both ammonia and urea. Meanwhile, simultaneously, the effective closure of the Strait of Hormuz has trapped a massive percentage of the world's vital agricultural inputs inside the Persian Gulf. Roughly 1/3 of all seaborne fertilizer trade passes through this single vulnerable strait, including an absolutely staggering 43 to 67% of global seaborne urea exports. Now, unlike crude oil, which can sometimes be rerouted through specialized pipelines in Saudi Arabia and the United Arab Emirates, there are no ammonia pipelines bypassing the Strait of Hormuz. When these crucial shipping lanes are blocked, the fertilizer simply sits in storage tanks until the industrial complexes are forced to shut down completely. And the consequences of this physical supply bottleneck are already devastating agricultural superpowers across the globe. India, which relies on the Gulf region for roughly 80% of its total ammonia imports, is currently facing a massive domestic production crisis. Indian urea plants have already lost approximately 800,000 tons of monthly production as they scramble to replace curtailed Qatari gas supplies. This represents a catastrophic 30% drop in domestic output just weeks before the vital Kharif summer sowing season begins in June. And when major nations realize their domestic food security is threatened by these supply shocks, they immediately resort to aggressive agricultural protectionism. China, moving rapidly to protect its own spring planting season, has suspended phosphate fertilizer exports through to August 2026. Furthermore, Beijing has restricted the vast majority of its other outbound fertilizer shipments, cutting off between 50 and 80% of its normally outbound volume. Scotiabank estimates that this aggressive Chinese export ban is removing up to 3 million metric tons of vital fertilizer supply from global markets every single month. Urea prices at the New Orleans benchmark hub surged to $674 per ton by mid-March, a 32% jump in a single week. That price point is more than 60% higher than the baseline levels recorded in late 2025, and the situation is completely structurally different from the 2022 crisis. Now, back then, following Russia's invasion of Ukraine and the subsequent sanctions on Russian exports by the US and the EU, Russian fertilizer exports were largely just rerouted to different buyers, whereas the current Hormuz closure means the physical product is stuck with nowhere to go. But before we dive deeper into the delayed impact this will have on your grocery bills, we need to talk about navigating these macroeconomic shocks. So, if you want to stay informed, make better investment decisions, and avoid being blindsided by structural inflation waves like the ones we're covering today, then you should be reading the Coin Bureau Finance newsletter. It's absolutely free, and we break down everything regarding global finance, commodity markets, macroeconomic trends, and monetary policy so that you never miss what truly matters. All you have to do is click the link in the description below or simply scan this QR code right here to get started. Okay, back to the delayed agricultural crisis. Now, the most terrifying aspect of agricultural economics is the built-in structural time lag. The fertilizer shortages and price spikes happening right now do not immediately translate into higher food prices at your local supermarket tomorrow. Instead, these input cost shocks must slowly move through a massive pipeline consisting of planting, growing, harvesting, processing, and distribution. According to commodity analysts at StoneX Group, this complex agricultural transmission mechanism operates with a mathematically guaranteed 6 to 12-month lag. Right now, farmers across the Northern Hemisphere are facing a critical spring planting window with margin-crushing fertilizer costs. Faced with these prohibitive expenses, farmers are forced to either drastically reduce their nitrogen application rates or switch to entirely different crops. Current projections indicate that United States corn acreage will fall by roughly 5% this year as farmers desperately pivot to soybeans, which require significantly less synthetic nitrogen. But when millions of farmers simultaneously reduce their fertilizer application rates, the global agricultural system faces what agronomists refer to as a yield cliff. Lower nitrogen inputs mathematically guarantee lower harvest volumes in the autumn, which inevitably drives up the price of staple grains heading into 2027. The International Grains Council is already projecting that global wheat and coarse grains harvests will fall 53 million tons below the previous season's record. And the human cost of this delayed supply shock is going to be devastating for the most vulnerable populations on the planet. The World Food Programme recently issued a stark warning that an additional 45 million people could be pushed into acute hunger if this conflict continues. That would bring the total number of people facing acute food insecurity to an all-time record of 363 million, surpassing even the worst peaks of the 2022 crisis. And this begs the question of how central banks will actually respond to this impending wave of agricultural inflation. Well, the reality is that institutions like the Federal Reserve and the European Central Bank are powerless against this specific type of supply-side shock. Central banks are currently trapped in a policy dilemma where cutting rates would pour gasoline on the inflation fire, but raising rates would further crush economic growth. The Federal Reserve has maintained a hawkish pause at 3.50 to 3.75%, effectively surrendering to the reality that they cannot fix a broken physical supply chain. Put simply, folks, we're staring directly down the barrel of a stagflationary second wave that will hit the global economy in early 2027. The first wave of inflation we experienced in 2022 was partially tamed by aggressive rate hikes, but this second wave is attacking the fundamental production capacity of global agriculture. According to recent commodity trading data, managed money accounts have established a massive net long position in the corn market, totaling over 312,000 contracts. Meanwhile, domestic fertilizer producers in North America are operating as the stealth winners of this entire geopolitical crisis. Because United States natural gas prices have actually fallen by 27% over the past 3 months, American producers are enjoying incredibly cheap domestic input costs. At the exact same time, they're selling their finished urea into a global market where prices have spiked by more than 60%. This perfect storm of falling local costs and exploding global prices has caused companies like CF Industries to see their stocks surge by nearly 64% in just 3 months. So, while the mainstream media continues to obsess over the daily fluctuations of Brent crude, the smart money is buying up the agricultural foundation of the global economy. We all now need to recognize that the price of our weekly groceries is inextricably linked to the geopolitical stability of the Persian Gulf. We are indirectly subsidizing this massive global supply chain failure every single time we purchase bread, pasta, or any product reliant on commercial grain. The fertilizer shortages happening today are locking in the food prices we'll be forced to pay 12 months from now. But what do you reckon about this massive agricultural disruption? Do you think global supply chains can adapt to these energy shocks, or is a massive wave of food inflation in 2027 inevitable? Let us know your thoughts down in the comments below. And if you're thirsty for more deep dives into matters of finance, then consider checking out our video on why the global copper deficit could trigger the next major commodity supercycle. That's all from me for today, though, so as always, thank you for watching, and I'll see you in the next one. This is Guy, signing off.